Morning, everybody, and welcome to the Daily Energy Markets podcast. It is Tuesday, April the 25th, and we have crude oil prices trading at a little bit unchanged, one would have to say, bouncing plus or minus a few cents off of the trading of yesterday. We've got Brent crude oil had a recovery yesterday. It started the day in early trade in Asia down 1% and ended up finishing the day in New York closing up 1% at close to $83 a barrel, currently essentially unchanged this morning. Let's kick off with Dr. Youssef El-Shamary, CEO and head of oil research, C Markets, senior research fellow at the Imperial College of London. Amongst a number of things, Dr. Youssef, that the market is waiting to see, I mean, essentially a market looking for wind, is the OPEC plus commitment to cut 1.6 million barrels a day from May 1st. Your thoughts on the outlook for that cut? Should we expect 100% of that?
Hello, good morning, Sheen, and good morning to my colleagues and all the organizers. So, as always, I'm always happy to speak to you. I think the cuts of OPEC Plus again show that the group is cautious and proactive to market dynamics and unexpected conditions. Of course, these cuts they came in the run-up. Of course, as you all know, there was the U.S. banking crisis and some concerns about a recession, especially in the Western economies. So I do think that the driver behind them are legitimate and they make sense. Now, coming to your question, if these will be 100%, yes, I do think so, because these are voluntary cuts. Not an OPEC plus cuts. That means every country has the right to cut whatever amount they want to do. Okay, and if you look at the number of countries making these cuts, all achieving the 100% or more of compliance, unlike Nigeria, Angola, and other countries falling behind their quota. So I do think that we're going to see a 1.6 million voluntary cuts in the months ahead, starting from May. Now, whether these cuts, of course, as we heard from the statements coming, that they will be extended until the end of December 2023. But and this is a personal opinion, that I wouldn't be surprised if we see additional cuts coming along in the months ahead before December 2023, if we see prices falling due to concerns over recessions, continued tightening monetary policy from the central banks, or weaker than expected reopening in China.
Well, let's see where that goes. Let's welcome Neil Atkinson, former head of Oil Markets Division, IEA. Neil, are you on the 100% train? OPEC Plus will deliver all these cuts, including Russia's phantom 500,000 barrels a day.
Well, I'm not entirely sure that it really matters whether it's 100% or 90% or whatever. I think it's a very fluid situation. I believe that the cuts that were announced last October and the new set of cuts that Youssef has just been talking about represented a masterful reading of the actual fundamentals of the oil market. The producers were not trying to necessarily boost prices significantly. They were trying to stop them sliding further. And I think they've achieved that. Now, what happens over the next few months is entirely dependent on whether we think the demand growth outlook weakens or not. I personally think it will. I've never bought into this big projected increase in global oil demand of over 2 million barrels a day this year. I always thought that's overcooked. And I would think, because of the economic uncertainty, the possibility of further interest rate hikes in the Western world, I think economic problems in China, supply chain issues, financing for various sectors of the economy, I don't think China is going to be quite as gangbuster as people think. So whether there'll be further cuts later this year depends on entirely on on the outlook for the global demand projections.
Let's welcome Salih Yilmaz, Senior Equity Research Analyst, Energy, Oil and Gas, Transition and ESG. My God, that's a bit schizophrenic, at Bloomberg Intelligence. Salih, I wanted to get your views on the impact of, I'm putting all of those pieces together that you're responsible for, oil and gas, transition, ESG. We've seen the European majors this year, one of the defining features is they're backing away from their energy transition commitments to try and look a little bit more like their American colleagues. What's your outlook for that and its impact for their equity prices?
I mean, I think that's been an interesting shift of kind of strategy. I mean, I think BP was the famous one where, they've kind of gone from having the most ambitious kind of energy transition targets to kind of backing away from it a little bit. And I think that had to do with how well the legacy oil and gas business has been doing versus, I mean, when we look at the legacy oil and gas business, we're looking at IRR of between 15 to 20%, whereas some of these kind of lower carbon ambitions and the endeavors that they had, they were looking at returns around 6 to 8%. In the best case scenario. So what we're seeing is kind of a little bit of a shift back to the fossil fuel business. And I think when you look at the outlook for the oil market, we've kind of been arguing in the last couple of years is that, demand has been a little bit volatile for obvious reasons. But on the supply side, we've been raising our concerns about, like, are we actually going to have enough supply to meet increasing demand? And
the energy security argument that we saw last year, energy security, energy transition, seemed to be in a bit of a tug of war. Are we seeing this as a victory for energy security?
I mean, I wouldn't call it a victory per se, but it's just that, the obvious mismatch between supply and demand that was being projected obviously would require more investment, and obviously just the OPEC and OPEC plus countries wouldn't be enough. Some of these majors, some of these European oil majors are responsible for a big chunk of oil production. So them kind of dedicating a little bit more capex perhaps between now and 2030 would indeed help a little bit on the supply side of the equation if we really do get a demand outlook that just keeps growing, or perhaps stops growing but plateaus at a high level and doesn't quite fall off a cliff, which would mean we would need more supply. And I mean, even if we don't need a lot more supply, I think many perhaps forget that you need a certain level of investment just to keep supply at the same level. So kind of bringing that investment back in the sector was arguably necessary.
Dr. Youssef, I wanted to drill down, no pun intended, in your comment there earlier that you may even see further cuts this year. What would be the sort of trigger for that? I mean, in the assumption that we get the 1.6 next month, what would trigger more cuts? The year of two halves, the major multilateral agencies, including OPEC itself, is holding on to its 2+ million barrels a day of demand growth this year, and yet they're cutting next month 1.6 million barrels.
First, the state of the economy continues to be uncertain. Now we are in getting to Q2, and demand coming from China has not been really a major driver for prices, not to prevent them from further downturn.
I mean, the prices haven't responded very positively to China's recovery, but indeed, China is buying a lot of oil. We had over 12 million barrels a day last month. It seems to be more about the demand weakness in the G7 rather than China not doing its sort of bit, if you like.
That's one reason, but another reason is that because China is buying a lot of discounted crude from Russia, so they're kind of well supplied. And I would expect if we have the weaker economic picture from the G7 and Western economies and continuing tightening monetary policy weighing up on the Chinese factor, then I would expect if prices fall down to 70 or they don't, or at least because here I think for producers to be less concerned, prices shouldn't go below below $80. So that's why one reason why I'm expecting additional cuts, especially ahead of the summer. Now, this is definitely uncertain because we still don't know if the economic picture shows us some better figures, especially from the United States and the Europe. If we continue to have better numbers coming, especially on unemployment figures and growth figures coming from the US, then I would expect that possibly we continue to see these cuts until December without any further measures. So that's, let's say, the two possible scenarios. But here, I don't think one issue here is that I don't think China will be a big factor in driving up prices, but they possibly, as Neil just mentioned, they will just act as a support from further decrease.
Neil, looking at the sort of outcome of where does Russia go from here, we have a story published today overnight from Reuters that Russia is on track for a 9.6 million barrel a day production this year, 2023. I mean, with all said and done, all the embargoes, all the price caps, nothing is stopping this Russian oil get to the market. Why would they cut 500,000 barrels? They're not, I mean, that would seem counterproductive on their part.
Well, maybe they won't, is the answer, because, they need every dollar they can get their hands on under the auspices of the price cap mechanism or not. I mean, the issue with Russia is quite interesting because as far as predicting the production levels from Russia is concerned, we members of the oil analyst community have got it spectacularly wrong since the early days of the invasion of Ukraine, when the fashion was that Russia's exports and therefore production are going to, if not collapse, certainly come down very sharply. But partly because of the price cap mechanism and partly because of the way in which China and India have been very happy to buy heavily discounted Russian barrels, the production stayed at very high levels. And I think the Russians will just play it week by week. They'll take each game as it comes, as they say, and they may or may not make cutbacks, but I don't think they will. If you were there, what would you do? You wouldn't cut anything. And
well, it's not been their kind of tradition to do so. Let's just put it that way.
Well, yeah, exactly. And I think that as Youssef said, these latest cuts are voluntary as opposed to part of a formal treaty agreed around the table in Vienna. And all of the countries, and not just Russia, will look at it from the point of view of their own interests. And we're in a very unusual situation these days when we're looking at production cuts, whether they be formal or informal, because in the glory days, when I was a young lad, 30, 40 years or so ago, there was no question of OPEC member countries being unable to produce their quotas. Everybody could, and it was just a question of how much they were cheating. These days, of course, as Youssef said, you've got Nigeria, you've got Angola, you've got one or two other countries that couldn't produce their quota if they pedaled faster. So, we're in a very interesting situation. I think Russia will not cut by the amounts that are suggested.
Well, not only are some of the major oil producers not able to produce at their quota, but the oil majors, Salah, ExxonMobil and others seem to be unwilling in 2022 to put any money in the ground, but more interested in putting it in the pockets of the shareholders. Should we expect the oil majors, particularly the American ones, to put a bit more oil in the ground this year and meet some of this future supply opportunity?
I think a little bit this year and perhaps gradually more so if oil prices hold up at relatively elevated levels. Because what we've seen is,
what is relatively elevated to people sitting in Houston?
I think current levels are quite favorable. Again, I mean, majors are different, right? I mean, you have the US majors that have a lot more shale exposure. And, like shale has its own kind of challenges when we look at perhaps getting back to the levels that we saw in the shale boom times, which we are unlikely to see again. I think there are a couple of reasons for that. I think between 2010 and 2020, they were very growth focused, and that wasn't very investor friendly. I mean, investors didn't really get what they were promised, they find. So now the shareholder base of shale companies are very much shareholder return focused. They don't want these companies to actually put the money back into output growth. They want the returns, and this is what companies are giving them. I mean, in the last few years, what we've seen is some of these listed shale companies, the moment they would mention in their earnings call that they might put a little bit more capex into increasing output, like their share price would react negatively. So I think after that period of time, now that's the main reason I think these companies are very much focused on returning to investors.
Do you think it would also indicate they don't have much belief in the demand recovery story of China?
I mean, perhaps, but I think their balance sheets are in a much better position. I think they're doing a lot more buybacks. They're giving more dividends, and I think M&A is very much on the table again for them to consider. And it's not because that these things they're doing, not because they don't think demand is going to be strong, but it's because it's their priority right now, and they think that's what perhaps their shareholder base wants. And again, I mean, going back to the shale point, I think perhaps some don't realize that some of the best acreage in shale have already been drilled. So like now we're actually moving on to what the industry calls tier 2, tier 3, where productivity is just not going to be as good. And then there's of course cost inflation. So all these things combined, I think, are some of the reasons why like even if you see that absolute capex number perhaps picking up, it may not necessarily result in much higher output for some of these shale names and perhaps some of the US majors.
In the past, the other thing that they don't seem to be doing yet, and I'd welcome your insight. I mean, with this kind of windfall of revenue, we've seen them spend it also on acquisitions. Do you expect to see any M&A activity in the oil patch going forward?
Yeah, perhaps. I think that they'll still be very cautious. I mean, as you say, they weren't always good at picking the right acquisitions. I think they've been some dilutive examples. I think they'll be approaching it cautiously, but I think their balance sheets are in a position where it could easily be considered. They'll be very picky. And again, perhaps contradicting our earlier points, I think some green M&A could be on the table for some companies as well, especially the European ones. Again, I think it is true that they're shifting their focus a little bit back into the legacy businesses, but for perhaps the right price with the right target, I think we could actually see some M&A by some of the majors where targets are some of the green names.
Let's go to the survey question for tackling what we addressed earlier. How much of the announced OPEC plus cuts of 1.6 million barrels per day starting May 1st do you expect to be implemented? Close to 100%, close to 80%, close to 60%, 40% or less? Where do you pin your tail on the donkey, so to speak, or as we said yesterday, grab the tail of the tiger? That was a comment yesterday, that OPEC Plus had grabbed the tail of the tiger. Where do you put these numbers in terms of expectations for cuts? Yusuf, I wanted to get your thoughts on the big geopolitical story of the region in the last few weeks, last few days, the crisis in Sudan, of course, which is just across the Red Sea from the coast of Saudi Arabia, where 5 million barrels a day of Saudi export capacity is based. Is Sudan an issue to be concerned about? It's in a current ceasefire for 72 hours. We've got a war finding hopefully some kind of end in Yemen at the bottom of the Red Sea at the Horn of Africa. We have Ethiopia just struggling to sort of throw away the shackles of a civil war, and here we are in Sudan at the beginnings of a civil war potentially. Your thoughts on the outlook for this as a crisis for the region, for the markets?
Well, the war in Sudan, certainly it's a regional crisis, but here let's look at the Sudan itself is not an oil producer as South Sudan. So if that was South Sudan, then definitely that could be an issue.
The pipeline for South Sudan comes out through Sudan, so it comes across the Sudanese territory to the Red Sea.
To a certain extent, yes, but definitely I would expect South Sudan to continue to produce. There could be some disruptions if oil facilities are targeted, but that hasn't come on the stories yet. So we have not seen any targeting of oil facilities. So I would be more concerned about the inland of Sudan concerned rather than the Red Sea, because Saudi Navy is in the Red Sea, and we've seen Saudi Arabia taking refugees from Sudan, those diplomats and other who were actually stuck in the war zones. So all the Saudi American efforts have been able to get many of these people. So I'm not surprised about the Red Sea itself, given the excellent connections between the Kingdom of Saudi Arabia and Sudan. But if the oil supplies, as the pipelines in Sudan are targeted, then that could be an issue for the export of coming out from South Sudan.
But
they could bypass that going to the shipping.
Right, and I wanted to get your views on I mean, we've got the on the ground picture, two generals fighting over the pot of gold, whatever amount it is in Sudan, but the 10,000-foot view of Russia wanting to put a military port base on the Sudanese coast, and apparently had permission that was already signed off. Is there a 10,000-foot geopolitical face-off here?
Could you repeat that question, please?
I say I wanted to get your sense of where the regional geopolitical position is here to understand how big a conflict this could become. Egypt, Saudi Arabia, the UAE, and Russia was looking to put a military base on the Sudanese coast.
Well, I think it's a concerning issue, Seen, because now we have two armed parties: the National Army against a militarized army group, and you have this militarized army group supported by some Western countries and even some Arab countries. So I understand that the Saudi position is at this stage is neutral. They're calling for ceasefire and for unity. I understand this is also the situation of the United States, but really it is very hard to see how this can escalate to a regional crisis. But I think the issue can be contained, given now we see a ceasefire initiated, of course, being called by the United States and Saudi Arabia. So I am somehow hopeful that we can reach a conciliation between the two militarized army before that can escalate into a regional crisis. Of course, we have major concerning issue here is the murder of a military official from Egypt in the conflict just a day ago. So that can definitely raise the concerns that can develop into a regional issue that can include multiple countries in the region. But until this stage, I think the issue can be resolved in using the diplomatic means.
Neil, bouncing from one war zone to another, is the Ukraine conflict now a marginal issue for the markets? It's sort of gone from the burning front page headlines.
Well, it's sort of become like the First World War, hasn't it? Where they sort of slog it out for 10 meters of gains a day. It looks as if this war is here for the long haul. It's been remarkable how the energy crisis, which was forecast as a consequence of the Russian invasion of Ukraine, has not really yet come to pass. The enormous price spikes we saw last summer in gas for Europe have basically all been given up, and we're down to prices which are much more normal, and where Europe is in a better position to withstand the coming 2023-2024 winter. So,
although we have a story overnight that the US Department of Energy has put some limitations on granting licenses for more LNG export capacity.
Yeah, I did see that actually when I was preparing this morning. And I haven't actually run those numbers as such yet. And that is something certainly to be concerned about, perhaps, in the medium term, because of obviously, if you do accept that we're in a First World War situation and the Russia-Ukraine thing will just be a slog for years to come, then yeah, that is an issue. But there are other places in the world which are seeking to increase LNG exports. Qatar is an obvious place. So yeah, I did see that, Sean, and that's certainly something to be wary of.
Let's go to the survey result and give Salah the last word this morning. Close to 80% is the close to 60% and 140 not getting much look in. Let's post that on social media for a wider audience. Salah, the last word to you on where we go forward in terms of this energy security versus energy transition in Europe. The idea that money will be spent in the new energy supplies, hydrogen, renewables, and so whether the US restricts LNG exports won't be an issue, or where is that balance going forward in the short term to the medium term?
Yeah, I mean, I think perhaps the developments in the energy markets last year were a reminder of how energy security and when push comes to shove is the priority for most. And at times like that, where we are reminded of that. But again, I think longer term, of course, focus on sustainability, kind of shift away from fossil fuels to more sustainable alternatives is still there. But I think...
And we saw the Germans moving ahead this week with the closure of their last 3 nuclear power plants.
Yeah, they did. And I mean, that is a good example of how these things can get politicized as well, because I mean, on one side, we are looking for lower carbon alternatives, which nuclear arguably is one of them. But then, at times we are shutting those down and actually moving to stuff that is more emitting in the short term. But I think in the long term, again, the sustainability theme will remain. But I think in the very near term to mid term, energy security for Europe, I mean, as you mentioned, and I agree with everyone everything that's been said. It's been a huge shift in the dynamics of the gas market, that Europe went from having LNG as a balancing factor to being LNG reliant. So now it needs that LNG to balance its needs. So it's going to be important that there is that LNG. It can actually get that LNG to meet its natural gas demand. So in the very near term, that is the priority. But I think long term, we will continue to hear and we will continue to see more investment going into renewables and other low carbon alternatives as well.
Well, we have to wrap it up there. We've had our half-hour review with Brent crude oil barely moving, barely has a heartbeat this morning, trading in around one or plus or minus 1 or 2 pennies at Brent at 82.76. It seems oil prices and maybe other markets too, a little bit frozen in the headlights of China demand recovery versus further rate hikes next week, or at least the expectation. Maybe once we get beyond the Fed and the ECB meetings next week and the decisions that they make, perhaps this market will find a China pull upwards, given the big holiday in China coming, where travel is expected to reach even greater than 2019 levels. Thank you so much, Neil Atkinson in Paris, Dr. Yusuf El-Shamari in Saudi Arabia, and Salah Yilmaz in London, I think. Salah, is that where you are this morning?
And in Dubai now, actually.
Oh, you're in Dubai. Sorry.
Yeah.
Okay. Well, you've moved to Dubai, so welcome to you. Thank you, everybody. We'll catch up every morning, 10:30 UAE time. All the best.